Join me as I dive into the world of wealth and taxes to find out how the rich legally avoid paying them. Let's see if I can break it down simply for everyone. To set the stage, this section introduces the complexity and mystique around taxes and how wealthy individuals seem to avoid them. It's important to clarify that the strategies we'll discuss are legal and accessible for anyone, not just the ultra-wealthy. This creates anticipation and clarifies the purpose of the video, to simplify complex tax strategies that are often misunderstood. We've all heard the rumors, right? The wealthy don't pay taxes, or rich people are always dodging taxes. It's time to set the record straight. The truth is, while there are some bad apples, the majority of wealthy individuals follow the law. The trick lies in knowing how to use the system to your advantage. Many people think that avoiding taxes is synonymous with tax evasion, but they're actually two very different things. Tax evasion is illegal. It involves not reporting income, lying on tax forms, or engaging in fraudulent schemes to avoid paying what's owed. On the other hand, tax avoidance is entirely legal. It refers to minimizing taxes by taking full advantage of legal deductions, credits, and loopholes in tax laws. Wealthy individuals don't always dodge taxes in the way people think. They use strategies that are built into the tax code, meant to incentivize certain behaviors, such as investing in renewable energy or contributing to charitable causes. The key is knowledge. They have teams of professionals, accountants, tax lawyers, who specialize in understanding tax law intricacies and crafting tax-efficient financial plans. This section sets the tone for dispelling myths. Here's the first mythbuster. Most of the tax avoidance strategies used by the rich are completely legal. I'm talking about things like tax deductions, credits, and trusts. These aren't loopholes, they're strategies that anyone can use if they understand the system. Tax deductions. The US tax code allows individuals and businesses to deduct certain expenses that are related to income generation. For example, if you're a business owner, you can deduct operating costs, including employee wages, rent, and utilities. Personal deductions include things like mortgage interest or charitable donations. These deductions reduce your taxable income, meaning the amount of income that's actually subject to taxation. Tax credits. These are even more powerful than deductions because they directly reduce the amount of tax owed. For instance, if you owe $5,000 in taxes but qualify for a $1,000 credit, your tax bill is reduced to $4,000. Wealthy individuals often use credits for investing in government-incentivized projects like renewable energy, solar panels, wind farms, or low-income housing. Credits encourage these investments by offering significant tax relief. Trusts. Trusts are not just for the wealthy, but they're incredibly effective tools for reducing taxes on assets and wealth transfers. When assets are placed in a trust, the ownership and management of those assets are passed to a trustee, and the beneficiaries receive the income generated. This keeps the assets out of the individual's taxable estate, thus minimizing estate taxes when transferring wealth to future generations. Key takeaway: the wealthy avoid paying excessive taxes by using legal, built-in strategies that anyone can utilize. It's not about cheating the system, but about knowing how to work with it effectively. A big part of the confusion around taxes is that the rules are always changing. One minute something is legal, and the next it isn't. That's why the rich often seem one step ahead. They've got teams who stay on top of these changes and know exactly what's legal. The complexity of the tax system comes from its constant evolution. Every year, governments adjust tax laws, adding new incentives for some industries and removing benefits from others. For example, tax credits for renewable energy investments have become more prevalent as the world pushes for greener energy, while deductions for business meals have fluctuated over the years. Tax experts monitor these changes to ensure that their clients are always compliant and taking full advantage of what's available. Meanwhile, everyday people, who often don't have the time or resources to track these changes, can miss out on key opportunities to save on taxes. This section aims to clarify that tax planning is not a set it and forget it practice. It requires ongoing attention and strategy. One of the most common strategies is using tax deductions. Whether it's investing in a business or donating to a charity, deductions reduce taxable income, meaning the government taxes you on a smaller amount. Tax deductions help reduce your taxable income. Common deductions that the wealthy use include business expenses. Running a business means you can deduct expenses directly tied to income generation, from employee salaries to office supplies. Charitable contributions. Donating to charities can significantly lower taxable income. For example, wealthy individuals may donate a portion of their earnings to foundations or non-profits, lowering their tax bill while supporting causes they care about. Real estate depreciation. Investors can deduct the depreciation of real estate investments over time, even if those properties are increasing in value. This allows them to lower their taxable income while their asset appreciates. Deductions are available to all taxpayers, but understanding which ones apply to your situation is critical to maximizing savings. Another secret weapon. Tax credits. Unlike deductions, which reduce taxable income, tax credits lower the actual amount of tax you owe. That's a game changer. Tax credits are incredibly powerful because they directly reduce your tax bill. Examples include energy investment credits. Taxpayers who invest in renewable energy systems, such as solar panels or wind turbines, can take advantage of federal tax credits that significantly reduce their tax liability. Low-income housing credits. Developers who build or rehabilitate affordable housing can claim significant credits that not only reduce their tax burden but also generate substantial profits over time. Wealthy individuals and corporations leverage these credits as part of their long-term tax planning strategy, knowing that the right investment can produce immediate tax benefits. Offshore accounts often get a bad rap, but they're not always the shady loopholes people think. Used properly, they're a completely legal way to defer taxes on income. The key is following the correct reporting procedures. Offshore banking is often misunderstood. While some offshore accounts are indeed used for tax evasion, the majority are perfectly legal if handled properly. The key is reporting income and following the legal frameworks in place, such as the Foreign Account Tax Compliance Act, FATCA, in the US, which requires Americans to disclose offshore accounts and assets to the IRS. The wealthy use offshore accounts to defer taxes, not evade them. This allows them to reinvest their money internationally without immediately paying taxes on foreign earnings. Taxes are paid when the money is brought back to the home country, giving them greater flexibility in managing their wealth. Here's a lesser-known but incredibly powerful strategy: trusts. The rich often use trusts to protect their wealth and pass it down to future generations without incurring hefty tax liabilities. Trusts offer immense flexibility for tax planning. For example, revocable trusts allow individuals to retain control over their assets during their lifetime but pass them to beneficiaries tax-free after death, minimizing estate taxes. Irrevocable trusts remove assets from an individual's taxable estate, protecting wealth from both taxes and potential creditors. Trusts also offer generational wealth planning. By placing assets in a trust, the wealthy ensure that their children and grandchildren inherit wealth while minimizing tax exposure. And here's the best part: these strategies aren't just for the ultra-wealthy. They're for anyone who wants to keep more of their hard-earned money. The wealthy aren't the only ones who can benefit from these strategies. With a bit of planning, anyone can implement similar techniques to reduce taxes and grow wealth. Whether it's maximizing deductions, taking advantage of credits, or using trusts, these strategies can be tailored to fit your situation. Educating yourself is the first step toward financial independence.